All right, this is being recorded. And one thing I mentioned at the beginning of all these webinars is watch this again. This is going to be on the long call diagonal. You don't have to watch necessarily this exact same long call diagonal, but watch this one or one of the other ones I've done in the past, because I try to teach these for specific situations. And in this situation, what I want to do is we've come up with a bullish bias on something, and we're trying to play this for a longer duration, okay? So we try to build these strategies. We come up with a situation and then build the strategy around that assumption. And this assumption will fit that rule then, okay? And for some of you guys that got the memo that this is on the long call Christmas tree, I messed up last week and did it on the long call Christmas tree last week and was supposed to do it on the long call diagonal. So we've switched those two around. They're still in the same bullish to neutral bias type category. So some of you guys that were participating last week let me off the hook, and I hope you guys are as forgiving this week for me as well. All right. So without further ado, let's get on with it real quick. Let me get a couple things out of the way. My name is Eric Wilkinson. Some of you guys may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I started trading in college with some money I had earned, and then after graduating, I moved to Chicago and never even filled out a resume, just walked on the floor and begged for a job. I got a job that first day and started working on the floor. And pretty shortly thereafterwards, I went and sold all my stocks that I'd been trading in college, got flat, bought myself a badge, and started trading on the floor. So one thing I got to go over here is any opinions, news, research, or analysis or other information contained in this webinar is considered general commentary and should not constitute investment advice, you guys. I don't know what's in your portfolios. I don't even know what your risk parameters are. So what I'm doing could be counterintuitive to what you're doing. And please remember that past performance of any trading system or methodology is not necessarily indicative of future results. All right. You can follow me on Twitter at Wolfman's blog. It's earnings season, so I tweet out a lot of my earnings stuff during this time because I do daily market commentaries in the morning where I go over all the economic data, what I think the markets are going to do, and then what trades I put on in relation to those assumptions. And you can follow us at ProTraderStrat as well for any other type of market wisdom. All right, so what I want to do is let's pretend right now we don't know what strategy we're going to be covering today, because we don't know what strategy is going to work with our market assumption. And right now, what we're kind of looking at is that we have a bullish market assumption. And I throw in this neutral in here because what we want right now, and it's kind of setting up pretty nicely, but where the markets kind of trail down, we want them to go across. We want this kind of action in the first like 45 days or something, maybe even a slow trickle up like that. We don't want any major moves because we are going to be short a call here, all right? And then what we want is then to get that rally after this short call expires, worthless in a sense. We're going to be out of this short call before that probably, but at the end of the day, we want this short call just to finance our long call, which is way out here, all right? So in a sense, what we're looking at with this strategy is that, we have an assumption that the market right now is going to, let me try and erase some of this stuff, my eraser. I'm going to use a different marker because I don't like having to erase it like this. So we're coming into this and looking at it like XYZ is the strategy we're looking at, all right, or the underlying I'm looking for. So we have XYZ. All of a sudden, I'm like, all right, I see this XYZ chart, all right, and I think that the market's going to go a little bit higher, maybe, not this month, but it looks like next month or down the road because of the way the markets are working, that I want to get long XYZ for the long term, okay? I want to be long term, all right? So In the interim, though, I'm kind of like, I'm a little bit neutral right here, but long term, I'm bullish. All right, so that's kind of what we're looking at. Because of the way the markets are setting up right now, it seems neutral, but long term, I am bullish. So that's the stepping stones to finding out whether or not we're going to implement this strategy. That's the kind of thinking. It's not like I am full on bullish right now. It's kind of, I'm bullish long term, but I'm a little iffy on the shorter term, just the way the markets are kind of setting up. And then that would give us the long call diagonal. That would probably be one of the better ones to set up for it, right? Because just a long call spread is similar to what this diagonal spread is, but the long call spread, we're looking for a nearer term bullish move. When you have a longer term bullish move, yeah, you could go out in time and buy a long call spread there, but why not do the long call diagonal spread and have that short term short call expire, and then we have that long call on for for all the intrinsic value, because we've paid for all the extrinsic value. I'll go into these definitions a little bit more. I just want to get you used to hearing some of these names. You know, intrinsic value is what the option is worth, okay? And extrinsic value is basically all theta decay and volatility and things of that nature kind of added in there. Those are the things that go away. The intrinsic value, what it's worth, will not, other than, you know, the market direction being wrong, just like a stock. You buy a stock, that's what it's worth right now, right? If it goes up in value, it's worth more. If it goes down in value, it's worth less. So we can have market directions that don't fit our assumption, but where we want to buy this strike, we want to try and pay off as much extrinsic value, which will decay to zero, as we can. All right. And by setting this up with the long call diagonal, we're going to buy the in the money call right here in the further expiration cycle. Okay. So, you know, right now we're going to be looking at the June is the nearer expiration and the July is the further expiration. So we want to buy this option out here and sell this option. And that creates the long call diagonal. Now, if you were to buy this front month and sell this back one, then that would be the short call diagonal. And I don't even teach this one. All right. I don't even teach it. Why? Because I don't believe in it. Why would I sell an option way out here with no theta decay or anything else and buy this one that has all the theta decay, right? That doesn't make sense. If I tell you I'm going to sell you something and it's going to decay away to zero in the next couple of months, if it doesn't work out, then, you know, you're probably not going to be real happy with that. So stay away from the short call diagonal. I don't even teach it. We're going to look at the long call diagonal, and that's named the long call diagonal is because we're getting long this one way back here. All right. And then we're selling the out of the money near expiration, which is what I talked about. This will be the nearer expiration. Okay. And we'll talk about strike locations as we go along here, all right, as we talk about these essentials to success. Now, with the long call diagonal or any strategy I teach, we need to know whether or not we have the right underlying, okay? So with that being said, the right underlying, if we were talking about XYZ stock, you know, EA Sports, what we need to do is look at this particular underlying to see if it is appropriate for trading options. So what we want to do is go to about the 35 days to expiration is really the wheel or the sweet spot, but it's also called the spot month. It's where the most time and volume is being spent on any given day. And right now, there's not a whole lot of traders getting into this May with only 8 days to expiration, right? They have all started moving out to this area, and this is where the most time and volume has been spent. So with my rule, it's any stock, XYZ or else, under $100. What we do is we take this decimal point right here and move it 3 places to the left, or actually on a stock under $100, it's got to be 10 cents or less than 10 cents wide, all right? on any stock that is over $100, let's just take a look at Pepsi, then we've got our decimal point here. Any stock over $100, we just move it 3 ticks to the left, 1, 2, 3, and basically 12.5 cents is what we're looking at, right? We could round that up to 13 cents, all right? So for Pepsi, my rule for being able to trade this is it needs to be at least 13 cents wide on these options, just out of the money, closest to expiration, right? And you can see that this rule is fitting that assumption. So that makes it okay to trade options, all right? The reason why we need tight bid asks on these, for one, we're using an expiration cycle that is further out of the money. That's not the spot month. So anytime it's not the spot month where all the eyeballs are, you're going to see them get a little bit wider. And we don't want to have to give up a lot of edge to get in and get out. You know, this is only 5 cents wide. So if I wanted to get into a trade here, I probably wouldn't have to give up but 1 or 2 cents, you know, from the bid or the offer if I was wanting to buy it or sell it. In this case, we're going to be looking to sell these, but I would only have to maybe offer it at 22, 23 cents, offered at actually probably even 24 cents. I could probably put it in an offer here at 24 and be able to get a trade. You know, this guy, if I come in at 24, since there's a lot of eyeballs, he might say, you know what, I'm willing to pay 21 cents. And that's free market price discovery. We start tightening it up. The more eyeballs that get in here, the better the markets are. All right. And if you're trading XYZ stock that's 120, you know, you could see these markets be really wide. Let's just look at the puts, for example. Like this could be $1, you know, bid at $1.30. All right. And on something like this, during open market operations, this rule is for open market operations. This is not after the close like we're looking at right now. So make sure you're following this rule during open market operations. But you could see that if it was $1 bid at $1.30 on this stock, I'm probably going to have to give up a lot of edge to get in and out of this, you know, because it's only one person maybe making the markets in here. So I might have to come down all the way to $1.05 before somebody decides to trade with me. So, and then if I had to give up that 25 cents, if I had to go down all the way to $1.05 to get my offer filled, and I'm at $1.05, well, I gave up a lot of edge to get in, and it's going to take me a lot of time to make up that difference in theta, days to expiration. It's going to have to take like 5-6 days just to get me back to break even. If nothing else changes, the underlying doesn't trade any different. The market doesn't move. Volatility doesn't move that we talk about. All of those things. We just had to give up too much edge, and that will affect our premium. And if these are 30 cents wide here, then back out here, you know, the July that we're going to be looking at, these could be like 60 cents wide, right? So we want to stay away from that. If there's a lot of participation in these, then these guys are also interested out here as well because they can start doing spreads, maybe leg into a diagonal or something like that, to create a hedge, all right? So try and stay away from that. Picking the right underlying is when we need a tight bid ask. And that rule of thumb, any stock, if it's less than $100, I'm going to go back to, the rule is less than $100. If it's less than $100, it needs to be 10 cents or less. It needs to be equal to or less than 10 cents. If it's greater than $100, then we just move the decimal 3 ticks, 1, 2, 3 ticks, right? So if it was, you know, a $200 stock, we just move the decimal 3 ticks and it needs to be 20 cents, right? So that's a pretty easy rule to follow. All right. And then picking the right environment. With this one, we have a few things going on here, right? We usually talk about picking the right environment, and we're talking about the IV percent. All right, we're talking about IV percent. We're still going to be talking a little bit about IV percent, but we are more focused. We want lower IV percent. It will work with just about any implied volatility percent. So we want to start with a lower IV percent anyway, but that's not really what I want you guys to take home here. We are having different months. So we have like June, July, and August expiration cycles. I'll do this kind of like what they do with the June, July, and August, kind of on the expiration cycle. This is symbols we used to use on the floor. If you guys are pretty savvy traders with options and stuff like that, just know that this is June, July, and Aug. All right. So the June, we're going to have implied volatility over here. We don't want a big variation between the June and July, and we want less than 2% Let's call it less than 3% right now. Less than 3% difference between the June or the July. Or if we're going to do the June and the August, it's still got to be less than a 3% difference. And what I'm talking about is we're going to look over at the option montage here and have to discern where that difference is. And what I'm talking about is right over here. So I talked about we're going to be looking at the June for selling. So we go over here and look at this implied volatility over here. This is Vega volatility. We need, what I say, less than a 3% difference. All right, so this is 18.83, and we go out to these July we're looking at, it is 19. So that fits the rule. I mean, it's less than 1% even. So that's good. And couple of things. Usually options are in contango. And what does contango mean? It usually means, or contango always means, that the back is higher, okay? And if you want to think about it, you always hear contango and backwardation kind of spoken in the same realm, if you will. And what I'm talking about with an easy way to remember backwardation, all right, backwardation, I think that's how you spell it. Backwardation, an easy way to remember this big fancy word is just backward down, all right? That's what backwardation really means. Backward down, easy way to remember. Backwardation means backward down, means further down. Further out is down. Right? Contango means that this, the further out is higher, which we are in contango here. All right. Just that's not really a part of this webinar, but I just thought of it. And an easy way I try and think of easy ways for you guys to remember stuff, like, theta is the thief. Backwardation is backward down. Okay. So whenever you're hearing that on CNBC, all these guys love to throw those words out because they're very fancy, It's in contango. It's in backwardation. And I had a friend that actually traded for years and years and was always like, I can never remember backwardation and contango, which direction that means. And I threw him out that hint, and he has never messed that up since. So contango is what we're looking for that rule that I'm talking about. We don't want contango any greater than 3%. We want contango less than 3%. If it's in backwardation, then we don't care, okay? Backward down is a green light for this, all right? This is also a green light, all right? But anything greater than 3%, I would say run away, all right? That's a red light. We got the red light here, all right? Stay away from that. The reason why is because why do we want that? Because we're in this particular strategy, we're selling here and we are going to be buying out here, right? So I don't want to sell low volatility and buy high volatility, right? That doesn't, I want to sell high volatility and buy low volatility is ultimately what I want. If they're very close in relation, then we're going to be able to cancel those out a little bit better, all right? So that's why I want you to stick with less than 3%, closest to zero is better. And if it's in backwardation, then you are all good, okay? Good there so far? So picking the right environment, less than a 3% difference, all right? And then picking the right duration, I kind of mentioned this. We're looking for that near term to be close to that 35 days to expiration, and the further one, we want longer, right? We want it outside of that. We want it like 80 days to 100 days or more, right? The sweet spot I found is we're selling inside of this area, right? We're selling inside of here because we get this theta decay. Those options, that call we're selling, we want that premium to go down, right? You sell high, buy low. We want that premium to go down here. Well, out here where we're buying a call, we want that premium to hold on. We want to hold on to our premium. We want that theta to eat away at this premium up here. We want theta eating away there. That's good for us. And we want the theta to hold on out here, right? We want to hold on to our premiums out here. So we're buying a call out here and selling a call in near so that we get this one out of the way and out of our lives quickly and easily, right? So try and work on that. It works. All right. And then picking the right strikes. If it'll let me change. Picking the right strikes here. We are going to start. I like to build this strategy a little bit different. You're a little bit different. A lot of people will talk about starting from the further duration strike. I like to come in and sell the strike. You know, we mentioned this. We're selling about a 16 delta in the near term. Oops, that's not a very good delta. There, I'll fix it. 16 delta in that June is what we're looking right now. And then we're going to be looking to buy about the 84 delta in the July. All right. So that's what we're kind of looking for. You could do it in the August as well because a lot of them right now don't have this July, which is surprising. But we can have this one, but we still want it to be close and start out with about an 84 delta. If you're going out, if you're skipping that one, you're probably going to be closer to like a 90 delta on these though, because there's going to be more theta in there that can decay away from us. So if you have to skip that month and go out to August, it might be a little bit more difficult for us to pay off all of that extrinsic value that we got going on. And then knowing our exit strategy. Oh, one thing I forgot to mention with this one here. We want to pay less than, so we pick in those right strikes with those deltas, right? We talked about buying this 16 delta June and then selling like the 84 delta in July. All right. But when we build this strategy out, we've created a call spread. All right. That's how we used to write call spread on the floor. So we've created this call spread and obviously wrote it backwards. Everybody will say July, June spread, but I have all kinds of bad habits from trading Fed funds. We quoted things from the front to the back, which was completely different from the rest of the floor. So I'm sorry for that. I'll try to change my habits there. The July, June, long call diagonal. And the other thing is, so we have a call spread here. We're going to end up paying a debit for this spread. All right. But we want to pay less than 75% the width of the spread. All right, so pay less than 75% the width of the spread for it to be a green light. If you're paying over that, it's starting to get very quickly towards a red light if you are greater than 75%. All right. 75% is a red light. All right. Stay away from that, especially in the environment we're in right now. Right. Because we're seeing some real good volatility in the fronts. Yes, you're buying. Oh, Banu, thank you. Banu busted me. You're right, Banu. Let me erase this stuff. We are selling the June 16 Delta, and we're buying the 84 Delta. Thank you for catching me, Banu. And we want to pay, and we're going to be paying a debit because this July is going to be the one that's in the money. And what we're doing is this debit, we want to all be intrinsic value, which is what that strategy is worth, okay? And then our exit strategy, because we want to pay no more than 75% the width of that spread, we are looking for a 50% of our max profit potential. So easy example is, you know, if we paid 75% the width of the spread on a $10 wide, right? We paid $7.50. And that's what our debit is. That's our max loss, right? Anytime you pay a debit, that's our max loss. And then that means our max profit is $2.50. All right? We want to take about 50%. So we're looking for 50% of that to get out, which makes us at $1.25. So once our strategy increases by $1.25, we're out. So we would write down on our little tablet or our book or whatever that we are getting out of this strategy at $8.75 is my exit. All right. That keeps you out of a lot of trouble. If you guys can sit here and think about it as, you know, the guys going for this whole $2.50, they're looking for like a home run, like off of a knuckleballer or something like that. One of the hardest things to do is hit a home run off one of those guys, right? Because it's a slow pitch. It's moving all over the place. That is like going for the home run. We are just looking for singles. I want to take little jabs at it, little bunts. I want to play small ball, move the bases, and win that way, all right? I don't want to go for the home run or the grand slam to win a game. I want to just keep nickeling and diming these guys as we go along, all right? So when we get out, we're writing this down in our booklet, all of these things. You know, when I come up with a strategy for XYZ and I'm trying to figure all this stuff out, XYZ, XZY, dyslexia, when I'm looking through these strategies, I want to write all of this stuff down on a piece of paper in a notebook somewhere, whether it's an ebook or whatever you guys have in your notes. Write all of this stuff down. Why you got in, what the environment was, what the duration was. All of these things are really important because you need to have the data going forward so you can look back and see maybe what had gone wrong. Maybe you bent a rule here or there and it didn't work out. Or maybe you even came up with something that I haven't seen and you're like, hey, this works better for me, you know, and stick with that, okay? If you find something that works better for you, I have no problem with you adjusting your strategy to fit that, all right? That's a good thing as far as I'm concerned. I don't claim to know every single thing about options or futures or directionality or any of that stuff. So just let me know what it is that you found, all right? All right. So your max profit. Your max profit is the width of the strikes minus that debit paid. Remember, I talked about it. We are looking at, paying less than 75%. So 75% on a $10 wide would be $75 or $7.50. We talked about that. $10 wide, and we subtract that debit, $7.50 equals the $2.50. That's what our max profit is. But I talked about it. we're looking to go at 50% of that. So we're out at $8.75. All right. All right. Some people say it could be unlimited because we have different option cycles. Remember, that short call could expire worthless, and we have a long call on that could go to infinity. So, you know, just know that. But when we're looking at the max profit here, this is during the life of that short call that we have on. All right. And then our max loss, anytime we have a max loss, it is the debit paid, all right, for this strategy. Because if you pay a debit, that's all your max loss is going to be in this case. Almost 99% of the time, if you pay a debit, that's what your max loss is going to be. The only time that is not the case is in the synthetic long and synthetic short, all right? That is going to be one of the very few times that does not hold true. And I talk about the reasons why in those type of ones, all right? So the break even is the long call strike plus the debit paid. So all we have to do is take that long call, that further duration, add our debit in, and that's where our break even is. We're going to be able to build this strategy out a lot of times, so we're able to buy the underlying under value, under where the underlying is currently trading. It's not always the case. A lot of times we are going to pay maybe a little bit more than where the underlying is trading. Just know that that's that theta or that extrinsic value we haven't completely been able to pay off. All right. So, but a lot of times you're going to be able to build this where the break even is below where the underlying is trading. Sorry I missed some of the webinar, but under what conditions in terms of price movement would you consider putting on the diagonal? So we're looking at this kind of strategy where right now is a good one. Maybe we've had a bit of a correction coming down, and we expect the market to kind of do this for right now before we kind of rebound. Or the market just kind of is trudging like this, and we expect it to kind of do that. Well, we're selling the call in here, and we've got a long-term bullish directional assumption here, all right? We don't know when that's going to start breaking out, but we feel like, you know, within the option cycle here, we're going to see some very slow grind, if anything, maybe even a sideways trade, okay? But out here, we're looking for an expansion in that, all right? Does that make sense for you? Any percent of the move, I don't really look at it in terms of that. It's more along the lines of the probabilities of this one never being hit. And we only have a 16% probability, if we're setting this up exactly according to my rules, 16% probability of this one being in the money, all right, at expiration. So that's what we're looking for in that one. Oh, so somebody's all over. He knows that I'm coming close to the end here and getting ready to ask. It seems like something like, something makes sense. Sell the short term and know the longer term is better once the company gets better. Yeah, and as a matter of fact, yeah, good example, Boeing. We'll check it out. So this is the part of the webinar where I'm like, hey, let's throw out some examples. We'll bring up the platform and see if that all works out for us, all right? So the first one was Boeing. So, yeah, you can throw it out in the questions box. If you guys want to see a couple of examples that you guys are believing is neutral to bullish going forward, then I'm all good with that, especially Boeing. You know, they've had some bad news on a computer glitch, and which was a very bad computer glitch. I'm not going to lie. And they probably made a bigger mistake by not even telling anybody that how to fix the problem if it were ever to be a problem. That was probably the major mistake. All right, so talking heads say we are at a market top, bullish on stocks. Am I bullish on stocks? Well, I'll let you know after tomorrow. I've been bullish until that Trump tweet, and I thought that it was going to kind of get redacted or retracted, I should say, not redacted. I hope they would have redacted it, but before he put it out, because I was bullish. I was thinking we were going to be doing pretty good here, and then that tweet came out, and everything's up in the air right now. All right, so Boeing, we're looking at this stock. Like I said, we got to go through those rules of mine, right, that we were going to talk about. So one of the first ones is picking the right underlying. Well, we've got Boeing here. It's a $350 stock. I said move the decimal 3 ticks over here. So now we're looking at an underlying that should be around 35 cents, right? So we're looking at a 35-cent wide bid ask in the closest or in the spot month. So we go over here during open market operations. After the market closes, all our orders get canceled. So you need to make sure this rule follows suit in open market operations. You can see right now they're 70 cents wide. So if this were during open market, I would say, hey, move on to another strategy, because if they're 70 cents wide here, they're going to be really wide in the back. Normally speaking, these are pretty good markets. So Boeing, let's just go with it for right now. The next step we would look at is we got 35-cent wides. I need to look at the month I'm selling, which is this one right here. It's 31, right? Did I line that up good? Yeah, 31. And then the one we're going to be, or that's the one we're selling, and the one we're going to be buying is out here. So here we got backwardation, right? Backward down. So that's automatically a green light. That's good, all right? It's not in contango. So that means we're able to sell more volatility, higher premium versus what we're paying for down here. One thing to double check on, make sure their earnings are passed. They are, so we're good. We've got volatility expansion. That's all right. To me, this market looks like it wants to come back up, right? I mean, if you were just looking at it for a, technical setup, that's a pretty good one. It's not confirmed yet. In my eyes, with this strategy, for me, the way I trade, looking at this, I look at candlesticks also. That to me looks like it's a bullish signal. So the point of control right here is usually where markets, it's the magnet. We got the magnet going on here where the market wants to migrate to. So it's not a whole lot of move. I just want to make sure my short call is up here somewhere at this level, right? So that it expires worthless. And I think the market will kind of trickle up to this area, maybe settle down for a little while, and then my call expires worthless. I've got this long call out here in the July that is going to increase in value, all right? So that's how I came up with my market assumption, let's say, and then I go over to the trade and go through, all right, 3 ticks to the left, that works. Got backwardation, that makes it even better. The next thing is duration. I need to look at this one and this one because that's closest to 35 days to expiration, right? So picking the right strikes then. Let's just go to this. I don't want all of them. I'm just going to go to 14 and hope that it gives me enough. It doesn't. So let's go to, let's just put in 30, double it up. So I'm looking at the 16 delta, like I said, 390. I'd like to just go over and double check my charts. 390 is above this other resistance. So I've got this as a magnet where I think it will probably go to and settle down. It could settle down right here. This is a time node where this is where the most time has been spent. This is where people have put the most money where their mouth is, meaning this is where the most transactions have been made, is right here at around 368, 370, okay? The most time has been spent at 356. That's not a major difference. I would expect this market to kind of migrate to that. So that fits all of those assumptions, right? So I'm going to be looking to sell this 16 delta. That's well above where I see some resistances. I think I'm good there. Look to sell that one. And then I'm going to go out to the July and buy this one in the money. So I'm looking for about this 84 delta. I'm collecting $2.50. Here's another little floor trader hack. Remember, in the money options have intrinsic value, what they're worth, and extrinsic value, what the theta, this is extrinsic value. These are worth nothing, right? Because the underlying isn't trading 375. These are worthless. But this 330 strike is worth, this 330 strike, the 330 calls are worth basically $24.13. That's what they're worth. But they're trading, the 330s are trading $35. Right? So you can see there's a big difference. It's almost $10 difference. Right? So we're going to try and pay off that this $10 is extrinsic. Right? One of the easiest ways to look at intrinsic and extrinsic value, though, is to just go and look straight over to the side here. I was looking at the wrong strikes. But the 330s are trading 35 here, and the underlying is trading 25, or 25 different, right? If this underlying, I don't know if I'm explaining this very well. These 330 calls right here, the 330 calls are worth, or you have to pay somewhere between $35, $33 and $35. See how the markets get wider the further we go out to. So if we want to know exactly what this 330 call is worth, then we have to look up here at the underlying and see where it's trading. Well, it's trading 354. Well, that difference is $24.13. Okay, so the 330 calls are really only worth $24.13. Everything else is extrinsic, right? The easiest way to do this is to look at the corresponding calls and puts, and you can see that the real value is right around that $8, all right? Or that's the extrinsic value is really right around $8. So if we were doing the 330s, we would need to pay off that. What I was looking at is we're selling these 390s and we're getting $2 and let's call it 70 cents because that's about middle market, right? $3.70 or $2.70. Now I need to go to the ones that are in the money. I'm just going to go over here and look at the corresponding puts to see, well, at what point do I reach that credit? Right? Right there. So I'm just going to go straight across and be like, that's the ones I'm buying. It's pretty close to those 84 deltas, a little bit further. And that's what we're looking for. I want to buy those and sell those. All right? So I'm buying the in the monies and selling the out of the money. 84 delta, 16 delta. All right? Now we can go down here and look at this. $60 debit, $60.60. All right? We're doing the 295 calls, and then we add in this $60 and 66 cents to see. So we got 66 here, we got 5 there, so 355. So you can see we are paying 355 for the underlying in a sense. So we're paying a little bit more. We're paying about $1.50 more. All right. So in this case, my break even. This is my break even. So I'd have to make up $1.50 to equal my break even. All right. I have $1.50 of upside to get to my break even. You could look at it again if that didn't work. You know, you don't want to do it that way. So I'm going to sell this one. And I was looking at the these here. I'm going to go one strike further and buy that one. Now, if we add that in, you can see I am looking at the 290s. We're looking at the 290s again with the 65.25 debit. So my break even is going to be at 355.25. All right. Now you can see I've gotten it a little bit better. It's a little bit closer. Still not great. All right. The last trade on that was 4, so that's what I'm looking at. So it's still a little bit. You got to still make up a little bit of difference on that to get up to your break even. You know, that to me would be, you know, it's one of those yellow light kind of things. Do you think that it can easily make up that $1.50 to make up your break even? Then go with it. Part of this problem is coming into the fact that we have really wide markets also in Boeing. I see a couple questions. Let me try and nail a couple questions real quick. How do you like the stock, General Electric, other stocks in this penalty box? I like General Electric. I don't think they're going anywhere anytime soon. But with this stock, it really, you know, you need to have underlyings that are plus, you know, $50 stocks. Sorry, I'm trying to write with a mouse. We want to do it on stocks that are greater than $50 usually. It makes the premiums a little bit better. You know, if I'm selling the 16 Delta on a stock that's less than $50, then this 16 Delta, the 16 Delta is only going to give you about 25 cents. So I like to stay away from that a little bit. Would you put the diagonal on if we have contango? Yes, but the contango needs to be less than 3% difference. I need to webinar for tonight. I have to go back to work for a little while. Okay, Lewis, I hope you can come back. It'll be sent out to you. All right, so let's look at another one. Let's look at Microsoft because Boeing's not giving us lovely markets right now. It is because it's after the market. So Microsoft, look at the underlying, move the decimal 3 ticks to the left. So 12 cents wide is what we're looking for. Let's delete this out. We go to the spot month, look at these ones that are just out of the money. You can see that even in the aftermarkets, these are tighter. Now let's go a little further out. You'll see that these, you know, these are still pretty tight also and would be very close to fitting that rule even way out here. All right. So that's ultimately a very good thing. We want to make sure we don't have an earnings cycle in this short call we're selling, right? Because in the short call, we see that heading into normal earnings cycles, we get spikes in volatility. Well, if I'm selling this call out here, if I'm selling a call here and they have that earnings cycle, we would expect this volatility to continue to rise heading into that event. And then after the event like this, we get that volatility crush. After this event, this was an anomaly over here, but you can see that this volatility got crushed after the earnings event. That's almost always what happens. So if I sold the call in here, we're going to be expecting this volatility to increase, hurting me all of these days that go by. Even if I was directionally right, that volatility increasing would make my premiums go up. So even if I'm directionally right and the market started going down a little bit heading into that earnings, but the volatility spiking could offset that, all right? And then I would have to go into that earnings with this short call on. I don't want to do that. If I'm in an earnings, I want this long call to pay me off. So this is where I want those earnings, not here, all right? I want the earnings out here to get that volatility expansion for me, all right? I want the volatility expanding around that earnings, all right? Does that make sense? So Microsoft fits that rule as well, so that's good. So fits the rule on picking the right underlying, picking the right environment. We're looking at the volatility. We want less than, 3% difference, all right? This is 24.5-ish. This is 25.5. It's in contango, right? Because it's going up. Back. If somebody says contango and you're like, which way is contango? Just think backwardation, backward down. Contango is the opposite. It's a little bit easier. So it's 1%. So that fits that rule. We're good. Then picking the right duration. We want as close to 35 days to expiration here. That's working. About, 75 to 80, some 75 days out here. That's good. We're working on that. That's good, picking the right strikes. We start out, I like starting out with the 16 delta and looking where my risk is to the upside, 35. I usually just go over here and check. All right, 35, that's a new all-time high. Well, anytime we start grinding on highs, the market has a tendency to slow down a little bit. So I don't want that actually. I want to go back to my thing. So that one works. I'll look to sell that one. So we got 65 cents. What's my rule? We look at the 84 delta if we've got it. We don't have an 84 delta. The other thing is just look over here at the strikes. All right, well, here's actually the 66 cents. That's the one I'm probably going to have to go with. I'll buy that. All right, so where's my break even? 25.65 because I add this premium in, right? I'm adding this premium into the strike here, and that gives me 25.65. Well, 25.65, that's pretty close. It's right in the middle of the range. We're landing right in middle market. That's good. That means we pretty much paid off all of our extrinsic value, right? We're getting this strike for value. That's good. That works. We're paying $20.65. Well, what's my other part of this rule that we haven't really gotten to because it wasn't working out very well? We've got $20.65. We've got to pay less than 75% of that. So $20.65 and divide it by the width of the spread. And we've got $30 wide. So divided by 30. Divided by the width of the spread, 68%, right? You times it by 100 to get your percent. 68%. So that fits that rule. It's less than 75% the width of the spread. That works. We're buying this thing at value. We're fitting the rule. We expect this market to kind of do a whole little choppy thing right in here and then start to rally closer to earnings, okay? That would work out. That's a good trade, right? Somebody else threw out another one. Johnson & Johnson would be a great one for this because Johnson & Johnson, you know, it's one of those boring stocks, right? Boring stocks just kind of trudging sideways. As a matter of fact, Johnson & Johnson is right here at the point of control, right? If you guys watched any of my webinars on points of control, you know this is the magnet. This is where things have a tendency to calm down. You saw it calm down here. Calm down over here. I would expect it to calm down going here, right? Yeah, I could test this high here, but I would expect it to want to stay in a range a little bit sooner. Usually the front week option IV is much higher than the back week. Is that good for a put or a call diagonal? No, we don't want a major difference in this. There's better strategies for that type of if you start seeing that kind of contango where the back months are greater than 3% difference. We don't want to do that because then we're paying too much we're paying too much premium in those back months than we are collecting in the front month, okay? And don't set this up in front of earnings, okay? Like I said, if there's an earnings coming out right here, I wouldn't want to set this up right now. This is great for setting up coming out of earnings. This stock has had its earnings. We would have expected the volatility to come out. We're actually seeing some volatility rise here, which is a good thing because we can now sell that call and know we're getting some premium, all right? That would be my theory in and around Microsoft. And that whole thing with me selling this call above where I think the market probably can attain, all right, in the next 45 days. And I'm buying this option for what it's worth so I don't have to worry about that thief in the night that comes and steals my premium over here. My boy Theta, right? Theta, we want Theta to steal all of this premium and the one we're selling, right? And we want all this premium to go to zero. So Theta, yeah, come eat away at me. But out here, further duration, we want to hold on to that Theta. We want Theta to be a positive for us. And if we can sell Theta when he's eating away more premium faster, like he's really eating away up here And out here, he's kind of got it in the cupboard. What about the short strike around dividend time? I'm not too worried about the short strike around a dividend on this strategy. I'd probably be more worried about the dividend on the put diagonal, because when we have a dividend of, let's say, they're usually doing a dividend of 90 cents, okay? So what is expected on the dividend date, so this dividend going to probably land right in here. So let me just make it a green one just to keep it consistent. Let's just say they have a dividend right here, all right? This is the dividend. On this day, the stock should drop, and they pretty consistently give out 90 cents. The stock should go down by 90 cents, all right? So on that date, we're expecting this stock to go down by 90 cents, which it might have done on this day. It doesn't always, oops, sorry, that's not the dividend date. This is the dividend date. So it's expected to go down by 90 cents. So if I can expect this market to go down by 90 cents here, or a dollar sign with that one, but 90 cents, that's good for my short call. So I'm not too worried about that. I definitely don't want an earnings happening right there, though, because why limit my potential to the upside with that short call well in advance of earnings, all right? I would never sell a call right now with an earnings in this month here, okay? It's just you're taking too much risk for the reward on that, all right? But this one works. Did I do the Johnson & Johnson? Let's take a look at the Johnson & Johnson one. So I'm going to go to closest to the 16 delta. I don't want to go way out to this one because I'm going to have to go really far in the money to pay off all that extrinsic value. So I'm going to go a little bit closer, 145. We check on the charts. 145 is up here. I'm good with that, being that far away. It's only got a 16% probability of being in the money by expiration. So then I look at the 81 cents. Where can I use this credit to pay off the extrinsic value? I'm going to have to go a little bit further into the money and do this one. It's got, oh, one thing I forgot to say, less than 3% difference. Right now, this rule is very easy because we've seen this spike in volatility recently. So it's making it very easy to figure out. So I paid $18.67, right? We got to figure out how much we're paying, the width of the strikes. We got $18.67. And we divide that by the width of the spread, which is 25, 74, 67. So we made that rule work, all right? It's less than 75% the width. And like I said, with these, I'm looking at the IV where you start. Normally, I don't know why it's not loading, but I start with the IV that are lowest and start working my way up on this one, trying to find, I would do this with the ones that don't have the earnings in them. I know these don't have the earnings in them. So I'd be looking at the stock. This one I could look at also. This one looks like it's kind of found a bottom. I might think that, hey, this is going to retrace back to the point of control and settle down there. That's where the most time and volume has been spent. That's where people have found value. I might think that it might want to come up there. So look for United if I was bullish. If I came up with that bullish assumption. Look at these right here. I don't like the half ticks, so I'd probably go a little bit closer, get that dollar. It doesn't have the July, so I'm going to have to go further out, which means I'm probably going to have to go further in the money than that 84 delta. So I collected $1 right here. These puts are worth about $1. That means the extrinsic value of these calls is about $1. I don't want to go through the math. I don't want to waste all my brain power, which is very lacking, on figuring all that stuff out. I'd rather use the hack and get a ballpark figure of it, right? Move on with my life. So $14, we got $14.40. Divide that by the width of the spread, which is $20. And we've got 72% the width of the strikes. That makes it work. If you want to find out where your break even is, to know where that is, add the debit onto the call. We got 84.40. So we're pretty close. We're mid-market on that. So I'd be pretty happy with that, right? And then my max profit on that, you know, if it's 14.40, my max profit is 14.40 and I have $24 wide, we've got $5.60, right? What's half of $5.50? Well, we're looking at $2.75. Add that into here. When this underlying is trading, when we're trading at $16 and what did I say was my max? 275. So actually, so it's at, when this is trading at $17.20 or something. My brain's fried right now. So when it's trading at $17.20, that's where I'm going to be looking to get out. Somewhere right around there. All right. What is the criteria for risk? Mistakenly placed a long call last October and anything would have turned to dust by December. So what is the cutoff on the downside? That's a great call. Deegan, you could be looking at this where, you know, if I was setting this strategy up around this setup, I would say right here, if it broke below my low today, that's where I would be getting out. Another rule would be a 50% reduction in that debit I paid. Now, that's not equivalent to the amount that you can make up on this, but remember, the probabilities are in your favor with the strategy. We paid off the extrinsic value. We've gotten it for what we feel is value. You know, if I were to just buy this stock because I think it's going to go up over the long duration, I would ask you the same question. Where would you get out? And use that same rule, right? Mine for this would be once it breaks below at a support level that, you know, once it broke what got me into this, once my assumption changed. If your gut, all of a sudden, you read something, you're bullish in UAL and you read something in the Wall Street Journal or wherever you saw an ad or that you didn't like or a tweet or something, and that changed your assumption and kind of got you worried about it, then I would pull the ripcord on it right then. I talk about this all the time when I'm doing daily market commentaries and stuff like that. You know, go with your gut because you guys have done the legwork to get into this strategy. You've come up with an assumption, however you came up with that assumption. And as soon as you get that like back of the head kind of thing going, wait a second, I don't know if I'm liking this so much. That's the time to really get out of this. Your assumption has changed and there's something telling you there's something going wrong. You can't explain it. Yes, you can use all kinds of reasoning to talk yourself out of that gut instinct. And that's probably the wrong thing to do. We can come up with all kinds of reasoning. There's something your gut is telling you that you aren't taking into account to change that, okay? Would you bail or convert it to a butterfly? I would not bail on this strategy on the downside or convert it. It's hard to throw good money at bad money. Like on a debit, it's hard to add, you know, something to this to make it better. Yes, you could go and sell some puts, but you know you're increasing your risk, right? Especially if you're directionally wrong, right? I would stay away from it. If you start questioning yourself, I would more so go to covering the spread. Does that make sense, Deegan? If it starts changing on you, bail on it. Okay? So, like, if I set this up for this reason, then that's where I would get out, right? If you're using, you know, Fibonacci, I don't even know where the Fibonacci for this are. But, you know, maybe I was doing Fibonacci. Of course, it landed right on the, you know, that's the same support area. So if it was Fibonacci and I said, hey, it broke this area, then I would be out of it, right? Okay. I might put you know, if my out wouldn't necessarily be this Fibonacci, I'd probably go, you know, a little bit lower than that, just because the market has a tendency to press on those a little bit more. Okay. All right. Does anybody else have any other questions? It's pretty simple, especially right now. The major thing to do is watch those volatility differences in the option montage, all right? Make sure there is not a big difference. Right now, it's you can throw your dart at them out of stock and it fits this rule. But if you watch, like I said, watch this again, watch this webinar again. You don't have to necessarily watch this call diagonal webinar. Maybe watch one of my other ones where there's times where I'm like, you know, it's a struggle to find the this rule to work. It's a struggle to make this rule work. So right now it's easy peasy to make this rule work. And like I said, you could even do it on the really high implied volatility ones, but it's better for the lower to mid-range volatilities, but major difference with my setups on volatility when we're talking environment is making sure these are very close in relation to one another. All right. All right. So this is the deal of the day. You know, if you guys have liked how I teach, you know, I try to give you guys little nuggets to make your life easy. And for 36 bucks, I think I can do that in just one of these webinars. The one I love the most, especially right now, is rising interest rates. This is a part of the portfolio nobody ever trades. And even though I probably say it 100 times on, you know, interest rates rising as it's the teeter-totter, right? As interest rates, if interest rates go up, right? We've got a teeter-totter here. As interest rates go up, price goes down. So you're holding price in your portfolio, and that is trickling down. Yes, you can hold it to expiration, you know, and you'll get that $1,000 back if you hold it for that 30 years. Most people hold it for 7 years. And you know why? It's because they're chasing the yield. You know, they're looking at, oh, it's 3% right now. I could get 4%. I want that 1% increase in coupon payment. Listen, these boys that are trading with you know that, and they are going to make that price dump. All right. It's going to take you about 5 years to make up for this loss in money. All right. It's going to take about 5 years of 1%, only 1% increase in coupon payment. This 1% increase is going to pay off this loss, and it's going to take about 5 years for it. So for 36 bucks, you guys, that's worth it for just that one. I'm not going to parade it, but you know, in all of my webinars, all my daily market commentaries, I try and come up with easy ways for you guys to remember this, make it make sense to you so that you don't have to mess around. This is in the chat window. This link up here, if you're watching this on tape delay, you're going to have to punch this all into your URL. But if you guys are watching this live right now, you can go over to the chat window and click on it. It's a lot easier. I've set it up for you. So what do you say? Go ahead and click on that. But any of these are great. The portfolio one alone will pay off itself right there. Anyway, I want to thank you guys all for attending. In later webinars, I'm going to be drilling down on different option components, when and where I find trades appropriate. Also, here's the link again. Once again, it is not a hot link. You're going to have to punch it into your URL. You can also reach out to us at 310-598-6677 or email me at trading@protraderstrategies.com if you have any questions. I try and make sure you guys are all taken care of. I want to make sure everybody is clear a concept, and love to chat with you guys. I see a couple of other questions. That's all I got for you. Other than if you can't take that, take it easy. And I'll answer a couple of your questions that I see popping up right now here. Give me a second to look at a couple of these. Thanks, Deegan. Appreciate it. To reiterate, you favor stocks above 50 delta or $50 with lower volatility for this strategy. Yeah, with this one, if you're doing it with a stock under $50, you know, it's just that I can pull up a stock. Let's try and find a low volatility stock, and Micron's probably got too wide a bid ask, but you know, this one's actually pretty good because they got huge volatility. Volatility is going through the roof for this one. So, you know, Micron in this regard is you know, crushing me because do they have an earning? They must have an earnings right here for that. Let's see. What's another smaller one? Apache. So when I was talking about like that 16 delta to 21 cents, you know, I'm going to have to, I don't know, 21 cents to me, if I'm going to buy this one, I'd almost, for 17 cents, you know, extrinsic value, I think I'd rather just not have the capped upside. You know what I'm saying? That's why I like it on the ones where it's like, all right, now I'm looking at like a couple dollar or a dollar of extrinsic value I have to worry about. You know, if it's 10 cents, then, you know, that's good enough for government work for me. That's why. Does that make sense, Philip? All right. Suggest buying the straddle. Interesting. Buying the straddle. He's saying buying the straddle right now. Deegan, somebody said buy the straddle right now. No, do not buy the straddle right now. You know, Deegan, talking heads on TV do not always tell you good trading strategies, or do not tell you the proper way to trade. I was in the pit. He says interest rates will move in the next year. I don't think they're going to move. I think they're going to sit right here. If anything, I don't think they're going to go anywhere. Yes. Listen, there was a guy that I used to fill paper for on the floor, and I saw him go on CNBC and basically talk and said, interest rates are going up. Well, what does that do? If interest rates are going up, then the price goes down. Well, he had a bid in the pit to scoop up all of those guys that listened to him on TV. And I'm not kidding. Like literally, I'm watching him say interest rates are going up and I'm holding his bid in the market, which means price goes down. He was holding the market up and talking, hey, interest rates are going up. He totally thought interest rates were going to go down. He doesn't care. So always be careful. You know, I'm not talking about the guys that are talking some of their trades and stuff like that, but and some of those guys I still don't think give the best advice on option trading strategies, even though I think they're good friends. We just have very different opinions on how to trade options. I like to increase my probabilities of success. They are more looking about directional moves. So they aren't worried about the theta decay or caring about the volatility. They believe their directional move will make up for that sometimes, I guess. But be careful of the talking heads. Sometimes they're trying to talk you into, you know, selling to them. All right. And watch some of my videos. If you are buying a straddle, you need seriously low implied volatility. All right. Because if volatility comes out of it, remember, volatility comes out of that, all of those premiums go away. And you just bought a bunch of somebody's volatility. Volatility usually reverts back, and we're pretty high right now. I mean, we can take a look at the VIX pretty simply. VIX, you know, when you see the VIX do these spikes, what happens? We usually get as good a slam down afterwards. And we've got a major spike going on here. I think there's going to be a slam down here. And if you bought the straddle, even today, you are holding somebody else's lunch. Okay? All right, that's all I got, you guys. Hope everybody has a great rest of the week and or weekend. Make sure you go get those Mother's Day presents before Sunday, because it's too hard to like run out right before breakfast and get some flowers. Believe me, it's not like when you're going over to mom's house and you pick up the flowers on the way. Well, at least in my position, being married, you can't do that. All right, take care, you guys.